Hello, everybody. Racheli here with Fairway Mortgage, your mortgage fairy. And I have three guests over here, which are partners in crime, helping people get better in life, get better financially. And I have Travis Rich to my right. I have Jason and I have Nick, and they are from Path Financial Partners. And they're over here to talk about some ideas and some things, how to help people get better. And we're going to try and gap the mortgage and the financial planning and use some tools that will help you get a better future. So tell us a little bit about yourself. I don't know, Rich, you want to start? Who's going to start?
Go ahead. I'll let Jason go ahead and start.
Well, first, thank you, Racheli, for having us on the show. This is amazing, great experience, and a great way to introduce ourselves to you. So combined, we're three financial advisors, and we actually have over 50 years of experience in the industry. We primarily help the educators in the Broward County School Board, higher education, through colleges around the local area, hospitals, and municipalities. So we are primarily helping a lot of the blue-collar workers. And we really want to start leveraging the different loans that Racheli actually has to offer in the mortgage industry with financial planning topics that will help you in any given situation. And one size doesn't really fit all.
We have options. So go ahead,
Yeah, no, Jason said it well, is we focused on the blue collar workers, right? People that don't think that they can make it financially because of their income levels and the amount of time that they have to spend, working. So our job is to come in and show them the path, no pun intended, on how to become successful with their income, with their future, with their goals, legacy planning, and those things that are very important to every family. And like Jason spoke of, no one's the same. I don't have the same goals as Jason. Jason doesn't have the same goals as Nick, but we do know how to create those pathways to get to those goals. And everybody, as long as you're going to take the time to sit down and understand that, you'll feel more educated and feel good about your plan individually and as a family. So that's what we're focusing on.
That's great. And Nick, tell us a little bit about you.
I think we've covered it. Been in the industry for a while, long enough, more than I like to admit. The grays are coming in, and it's just I think one of the biggest niches or gaps that we fill is there's a lot of people out there that focus on the wealthy. Most consultants tell us to do that, find those big whales, but there is such a need out there for.
There is a void.
There is a void. There is a void. That's a great word for it. Of I have enough money to where I need some help, but I don't have anybody necessarily offering me any legitimate help. And we joke about it. Like, we feel like that group is usually getting one of two things in this world. They're either getting a free chicken dinner or some product, or they're getting an 800 number. And there's not a chance for them to build a relationship with some financial professionals. And with the three of us, we are growing, but we can't quite fill that gap, but we're doing our best to do it.
That's what we want
to
do over here, which is spread the word and tell people. And I can tell you something. Somebody who owns a home is, I forgot how much more times are better financially set in the later years of life.
It's because you can do so much with it.
Yeah. And we're going to talk about some ideas of how to utilize some money, or you leave some of the money invested and get a bigger mortgage so you can build some wealth later on in life. And I'd like to start with something that we discussed like right before, and you did not know all this information, and it's about reverse mortgage. Yes, it's for those people that are over 62 and a half, but you can intertwine financial planning, financial advice, home ownership, mortgages together to build something much, much
It was
bigger.
Fascinating information. It really was.
Yeah. And what it is basically that you can buy a home with a reverse mortgage, or you can refinance your current home with a reverse mortgage and utilize the asset that you have there. You can have monthly payment paid to you. You can get the home equity line that you earn money on it, or you just put less down. Instead of taking all the money from the investments to put on a house and pay it for cash, so you don't have a mortgage, you leave those to grow.
Yeah,
Yeah.
you don't have to be cash poor to make a move in a decision.
Correct.
And
Cor-
have a better lifestyle throughout your retirement and not have to live paycheck to paycheck or social security check to social security check.
right.
And
And
there's plenty of people that are in that niche, right? That
Yeah.
62 and older that feel maybe I haven't saved enough, right? You
Mhm.
sit with Nick, Jason, or myself, and you're like, I just didn't know this stuff back then, and now here I am in my mid-60s, getting closer to retirement age, and I want to stop working. I just don't feel like I have enough.
Mhm.
Well, did you think about this other side, which Racheli is a guru on, and helping us to understand even more things that we can offer our clients as a team.
Right.
And that's a big thing, is building a team of people that know how to, get you in the right direction to see these things and unfold these things, because they're just incredible for your benefit in the future and for legacy, just stop with
Absolutely.
you.
Absolutely. And I want to mention something. We have right now there is a program that's coming out in Florida. It's called the Hometown Heroes. And
Heard that.
it's a down payment assistance for our servicemen and women who are working here in Florida. This year, there is like a little bit of a change. It has to be first responders, EMS, teachers,
That's-
nurses, all the people who are serving the community.
And we work with a lot of first responders.
Mhm. So we can help them get into home ownership. But the beauty about it, I gave an example. You can buy a $600,000 home. Don't take $20,000 from your retirement account that you have with the firefighters or with the police or with the school. You can get it with $6,900 out of pocket. I did the calculation. People are like, what? Can you get that? Yes, right now it's sitting in our governor's desk. They need to pass it so we can have the money. Usually we get it July 1st this year. It's going to be a little late. But
So-
that's another idea how to use what you have, your pension plans that you have with the state or with the county, and don't use it to buy the house. There are other programs that we can utilize. Leave that to grow while you're buying your home.
Yeah.
And all of you were sharing with me that you bought homes in 2017, 18.
2019, got real lucky.
2016, yeah.
17, yeah.
Yeah, and I bought mine in
The rates,
2000.
the rates were different. The
Yes,
rates were different.
yes.
It's timing, right? Sometimes you have good timing, sometimes you have bad timing, but the point is to ask the right questions, have the right people around you to ask those questions and
Mhm.
get you the answers, because I feel like that's the biggest problem is people aren't asking enough or don't feel like they're comfortable to ask enough
People
questions.
don't know that they need to ask
Yeah.
and what to ask
Well,
and
that's-
where to
that's
go to
always the
get
case,
that
yeah.
Right.
help.
One of my pet peeves in life is when an expert asks me, we're maybe done with the meeting or a conversation. And they say, all right, Nick, do you have any questions? And I always have that same feeling. I think this echoes for a lot of people is I don't know what question I should be asking you. I would rather have the expert come to me
And tell me.
and tell me what are those questions I should be asking.
Here are the top 5
What-
questions that I get in my field.
Exactly.
Yes.
And even being a little, cynical is, what am I not asking that I should be asking
Right.
that's going to give me the keys to the kingdom?
Okay. So if you take that $1,000 a month and you invest it for that full 30 years, after 15 years, you're going to accumulate enough money potentially to pay off that home. That at 6% interest rate, you're going to have somewhere around $293,000 saved up after 15 years. At an 8% compounding interest rate, you're going to have about $350,000. That should be enough to pay off the loan at that 15-year mark, or take the money out of that, let it continue to keep compounding, and pay off your monthly mortgage payment for the next 15 years.
Yeah, use that account to pay your mortgage
Yeah.
at that point. At the end of 30 years, you have a house And you have a nice nest egg.
Yeah, so a lot of times when we meet with our clients that are nearing retirement, and they have this lump sum of money, whether it be the drop program, the deferred retirement option program that they take advantage of, especially the school teachers, firefighters, police officers, and such, is they want to take that lump sum and, well, Travis, I owe 200 on my house. I just want to get rid of it.
Yeah,
I just want to
have
get
the
rid of that
benefit.
payment. And you know, we get the mindset of the no debt, right? I just don't want that. I don't want
Yeah.
that. Well, sometimes, like we've been speaking about, that is okay because of the leverage you have in the home with the equity. So there's no point to just take that $200,000 and throw it on the house when that's already built in. And Racheli can definitely speak more on how we can take that built-in equity and leverage that for even a better retirement, more money coming to your home and to
Yeah.
pay your needs.
It's even us as professionals, we nerd out all the time on the math and the numbers and what's offered out there. And I still feel like sometimes I'm behind. Even though we're all truly passionate about it. And if in Jason, your example there, even if you're not following the math, I think a couple of those takeaways are, one, all the numbers that you did is the exact same budget, cash flow, money in, money out of what you're spending each month. So nothing has changed. It's just being smarter with what you're already doing.
Right.
You know, so and that's really a common theme to everything we've talked about or are going to talk about today, is that we're not changing what you're doing. We're just changing how you're doing it.
Yeah.
Correct.
Next chapter in life, even that much easier.
Yeah.
Well, that's a good
Right.
point. And you can talk to this, Travis. I know you've talked about this before, is a lot of these things you do need some type of financial discipline.
Yep.
That's one
Yes.
nice thing. People, if you've bought a house, especially in Florida, South Florida, if you point at a date in history, if you bought a house and you still have it, chances are you have equity in the house.
Mhm.
Because it's a forced discipline. You know, unless you're strategically doing something, your equity is going to build up. And that's what's versus renting. If
Yes.
I rent and say, oh, I could put away this money each month, that's not a forced discipline. That's I have to make that choice.
But think
every
about
month.
that one.
Yeah.
I have people coming to me that they're paying $3,000 and $4,000 a month,
Yeah.
and they're doing it now for 3 or 4 years.
Or longer.
How much money have they just poof?
Yeah.
Other people's pocket.
Yeah.
That's equity building in somebody else's pocket.
Absolutely.
As good paying Americans, we're not good savers. We are good spenders. So it doesn't.
Well, then think about this. You pay off that home. It's a constant, money's going to the home, right? Every homeowner knows you're putting more money into your home every year. We can't control, we're in Florida. It's hot, right? Your AC breaks. What happens? That's a
You
good
gotta fix
$8,000 to
it.
$10,000 fix if it's a new one. A roof leak, right? You know, we're constantly spending money to upkeep our house. And if you take all that money and a lump sum, you throw it in, right? Now you're cash poor. What are you going to do? You're going to lean into the home and the equity anyways. So why not have that strategy out in front, see how it's going to work for you, so you don't just go ahead and be cash poor and then all of a sudden play catch up on, oh,
Yeah.
wow, I could have done this or I could have done that.
That's a good segue. So let's pivot there, right? And what we really want to get to is finding out. And I'll just start with an example. Is if I have my home, let's say we'll do 3 different examples here in 3 different scenarios to really show how you can. I don't like to say leverage because I just think of debt whenever I say leverage, but you can use your home equity in a new home or existing home. And even if you are or not financially fit on the other side of the balance sheet, meaning what do I have in credit cards or IRAs or Roths or 401ks, is how can I, and again, without changing up my life, is how can I enhance my financial life for myself, my loved ones, me as a guy, sometimes I think as the provider, as you know, to my household. So in that first scenario, let's say, I'll give you my scenario here. You can take it from there. Is let's do the easier one of that. I have a house free and clear. You know, I just pay, all I'm paying is my taxes and insurance. It's worth about $500,000. So I have $500,000 of equity. And on the other side of the coin, I'm retired. I'm collecting Social Security, me and my spouse, and I have some money, you know, say I have another $500,000 in my IRA that I'm taking a 5% withdrawal rate. We'll just say that's what their financial advisor told them. That's not advice, just an idea. And so my household income at that point is my two Social Securities and $25,000 coming from our IRA. And I'm sitting in my house. And so at that point, I would say I'm very equity rich. You know, I have this really nice asset that I live in. And in today's world, we have to hear this answer in today's 2025. What's that first step or that first idea of how can I use that $500,000 of equity in my house to make my life better without feeling like I'm losing my house or I'm getting upside down or the Mr. The next market crash is going to destroy my family and my inheritance. So what's that first idea there of how I can use the equity in my house while still living in it?
Okay, there are three ways we can utilize
Okay.
it. One is a straight reverse mortgage, which let's say that you are 68 years old, you can get somewhere around 45% of the 500,000. Let's call it 50 for now, so it's easy. It's $250,000.
Okay.
And we can use this money to enhance our investment, to take care of the house. Maybe it needs a roof, maybe it needs something, or maybe we're gonna take it and have a little bit better life for the last years of our life. So now we have that money. We never have to put the mortgage payment in unless we want to. And once we die, whatever equity is left in that house goes to the heirs.
All right.
If there's no equity, there's no equity. You wouldn't have had equity otherwise.
Yeah. So let's run those two scenarios. So in scenario one, where I'm just living in my house, I leave, I just don't do anything with the equity in my lifetime.
Mm-hmm.
So if I can say I got my $25,000 of income from my IRA, and between me and my spouse, it's another $50,000 coming from Social Security. Before taxes, before write-offs, my gross income is $75,000.
Mm-hmm.
So I have to live off the $75,000 to pay for life.
Right.
Now let's do that same math, staying in my home and using the 50-50. So I'm gonna get that reverse mortgage of $250,000.
Mm-hmm.
So what is that? Walk me through that a little more, drill down on that a little bit. What does that look like month to month as I live now from an income perspective? So
Okay. Well,
before I did, I'm at $75,000 of income.
mm-hmm. Now we're gonna do where we take this $250,000 instead of in a lump sum.
Mhm.
We're gonna ask that reverse mortgage to send us, let's say it's $2,500 a month extra on what we already have. So that's $30,000 that we're gonna get extra to make our life a little bit better. So every month, instead of writing a check to the mortgage company, you get a check from the mortgage company.
Sure.
And to add into that, that is not taxable.
I was just going to say, Jay, take us away on the tax.
Yeah,
part. So you're going to enhance my life going from $75,000 of income a year,
Which is taxable.
which is for the most of it's
Most part.
taxable. I mean,
Yeah.
not all Social Security is taxable. That's a whole nother podcast.
Yeah.
You do get your standardized deduction at minimum. So it's not all taxable, but in any other conversation, if I say, I'm going to have another $30,000.
We're adding
of
30
earnings.
grand.
Yeah, you're adding 30 grand. That's usually right off the top, right on the top. You're going to
Yeah,
get
the spidey senses come up. for
yeah,
the
yeah. As soon as I hear that, I'm like, oh,
Yeah.
we got to talk taxes. But in
Yeah.
this case, Jay, talk a little bit about that. Adding this $30,000 to enhance my life for as long as
Correct.
my spouse and I live.
And please, those numbers are just examples.
Yeah, example.
Please
Completely.
consult your CPAs, financial advisors to make sure that you have your numbers. because
Educational
it's
purposes.
Just educational purposes.
Yes.
Yeah.
Yeah.
So, but if you can, Jay, talk to the taxes a little bit as not being a tax expert, full disclosure, of the benefit of that extra $30,000 a year of income, $2,500 a month coming off of the equity in your home.
Yeah, well, the first thing is that you're not pulling $30,000 out of your IRA, so that
Right.
nest egg continues to grow, and hopefully there's money left over to go to your heirs in that sense too.
Yeah.
It's amazing. It's tools to use to make your life better. That's basically the bottom line about it.
And you're sitting in it, right? Every day.
It's sitting in the blocks.
Every day we go home and some people just don't realize what that nest really could provide you, an extra nest. $30,000 I can't imagine I'd sit in front of any of my clients and say, hey, did you know that we could do this and show them $30,000 of tax-free income coming back to them? It's just
Absolutely.
incredible to even know that that's a possibility. But again, it's talking to the
But-
right people about it.
Let's hit the next two
Sure.
ideas or two examples, but then I do want us to play a little devil's advocate here.
Mhm.
And not right now, but in a second. Just want to introduce the idea for when does this not work? Because I know me personally, I hate when someone's like giving advice or I'm watching a YouTube or whatever it might be, and they're making the thing sound like this is right for every single person on the planet. Why, if you don't do this, you're dumb. So I do want us to give examples of, even though how really awesome and great, and there's so many good advantages here, of when it doesn't make sense. Because I think if we can understand the flip side to it, that'll also help us understand where it does make sense. But before we get to that, let's do our other two examples here. So I got the first one where we have our $500,000 house paid off as an existing property, but I want to flip that into, what if I'm buying a home?
Mhm.
So, and I believe it's 62. You have to be 62
Right.
to qualify for this reverse type mortgage world, because it's very dynamic. But give us the example of if I'm buying a house.
Mhm.
You know, we'll say same couple, right? They have a $500,000 IRA retirement, and that's our side of the coin.
Mhm.
They both have their Social Security. They're retiring. Now they live in the Northeast. I have an expensive home
Yeah.
in New York. I'm moving to Florida. So I'm going to sell my home up there, and we'll just stick with the $500,000. They sell their home for $500,000 up there, and now they want to buy a $500,000 house here in Florida.
Here.
So I think the traditional sense, again, going back in time, you would say, oh, I can sell my house for 500,000 up there. I can buy a way bigger house in Florida, maybe close to the beach, and not for $500,000, but
Certainly
and
not
so
now.
then I can move down here and I have no mortgage.
Right.
So let's say that's the old way of thinking, which is a beautiful thing. Let's fast forward to today in 2025. What could I do with leveraging? I just sold my house for 500,000 in the Northeast. I have a property here, the home that my wife and I are going to retire to. That's purchase price is $500,000.
Mhm.
What's another way I can acquire that with using a reverse mortgage for a purchase?
Okay.
And walk us through that, because I think this is fascinating.
Okay. It's called the HECM.
Purchase my home in Florida. And so you said, I put down how much?
250.
250. Okay. So immediately I have $250,000 of just flat out equity in my house.
It's based, by the way, on the age, but let's say that you qualify as far as you age for
Okay.
50-50.
Yes, because it is age, things like that.
Yeah.
So now, in the bank, still staying at step one. So now in the bank, I still have $250,000 of cash left over that from my sell of property,
Correct.
right? So I put $250,000 down. And now you were saying get a first mortgage. What was the balance you said?
I would say 100,000
Okay,
on the
100,000.
first mortgage.
Okay, so let's pause there. So now I have what I think of as just a traditional mortgage.
Mhm.
I borrowed $100,000 from the bank to help buy this home, and I'm going to amortize that over 15 years.
But
30
it's a
years.
reverse mortgage, so you don't have any
Oh, it's
mortgage payment.
Okay.
So there are
So
no.
I said it wrong.
mortgage
See, I'm
payments on.
already getting it wrong.
That's the
So,
big key right there.
so-
the lack of payments.
then my okay. So, and then
The home equity line is there for you. Do you want to draw out of it $2,000, $1,000 a month? You want to leave it alone because you don't need the money? Keep it there.
And
Things
adding
are
to it,
growing.
that's a different dynamic that we
so
discussed.
that's where my mind just starts firing.
It-
And Jay, I'm
yeah.
gonna pass this to you. So explain that for us. You're gonna buy a home for $500,000. You're gonna use 250 of your own, but then you get these two different reverse mortgage structures, I'll just call it that, to where I don't have a mortgage payment at all.
Mhm.
Still,
And
even
have
though
access to
I kept
Mhm.
$250,000 in the bank. And then I have this first, I don't know, is it even called a first and second? Like a
Yes.
first, yeah. So
It
it's
is.
almost like I have a first mortgage, but I'm not making the payments.
Correct.
The bank's making the payments, or the lender is making the payments for me. And then that home equity line,
It's there.
it's there, meaning it's like having well, Jay, walk us through that. So how would you use that home equity line? Explain that to me. Like, so there's 150, so we're saying
It's your
$150,000.
emergency account for whatever
Correct.
reason.
Mhm.
Your roof, you need to replace it.
Yeah, the roof,
Yeah.
the air conditioning, which happens all the time. Travis mentioned that earlier. It's there to create income for you.
Make the house nicer.
Yeah.
right?
Yeah, absolutely.
Got a pool.
Have a better life. It's your end of the life years, and maybe even if it's 30 years, if you keep yourself in good health.
So there's
Take it.
there's this bucket of money I can dip into,
Yeah.
150,000 if I want to, right?
you
Is that
want
what
to.
we were saying? Now, what happens if I don't use it, or the portion of it that I'm not using? What's happening then?
It keeps growing.
So explain that. What do you mean it keeps growing?
Let's say you pay 7% on your first mortgage.
Right. Okay.
You're gonna earn 7% on the untapped amount of the home equity line of
Wow.
credit.
Wow. Yeah, that really is to be able to have equity in your home.
And someone else is going to pay you interest.
Yeah.
Crazy.
It's the analogy. I think going to a casino is fine. Go to the Hard Rock here, but I'm a horrible gambler because as soon as I'm up $100, I quit. If I'm down $100, I quit. I'm out. So I never stay very long.
You're a good gambler, actually.
Yes, that's right. I always have this.
the Hard Rock.
As soon as I walk into the Hard Rock, or any casino, I always have. There's a feeling that always comes to me, which is I want to be on the other side of the table.
Yeah, you want to be the house.
I want to be the house.
Of
I want to be the house. And I think there's a parallel here with when you use reverse mortgage, this whole realm properly. Now you have the debt on your house paying you.
Mhm.
And correct me if I'm wrong here, so I'm piecing this together. You have the debt on your house, the interest paying you, in your case, you're 7%, versus me paying 7% on the debt.
On
of
the
my
first
house.
100, you are paying the 7%.
The first, yeah, I'm talking about that equity line.
But the equity line, you're earning money
Right.
on it.
And we could use that equity line, correct? We could take
Yes.
that 7% that we're earning,
Correct.
that's
Yeah.
compounding, and still leave the 100 in there. So
Mhm.
in year one, if I didn't touch it, I have 107,000 in this example.
Yeah.
I could take that 7,000 out in year two. I'll be back to 107 because it's 7% on the.
It's 7
So now I have $7,000 at my exposure to utilize
to utilize.
certain things.
Yeah,
Right.
you're
Yeah.
using your home, you're using financial tools to better your situation. Period.
Well, and
Right.
the same example though, Nick, you had $250,000 sitting in your bank,
Right.
right?
Yeah.
And somebody that's working with someone like us, that's not just gonna sit there,
No.
right? Because we're retired, we're trying to live in
Right.
this beautiful state,
Right.
right? So now we have that earning interest,
Yeah.
right? And there's certain,
Yeah.
there's a million different products that we can, configure what fit
Yeah.
you best on those
Yeah,
earnings.
that's either money now, later, or never, depending what you want to do. It
Right.
could be, I mean, that can be bucket list money. That's just extra found money. And there is a point in life where our expertise is needed to help someone spend their money
In a better way.
in a better way.
Yeah.
I don't know if sad is the right word, but it irks me so much when I've worked with someone for years, or it's someone new, and they're getting up there in age. They're in their 80s and 90s, and they've been such good savers. And Jay, I know you talk about this a lot. Been such good savers, it's hard to break that habit. They were such good savers through their whole working career.
Mhm.
It's really hard to break that habit and be comfortable spending
Yeah.
in retirement. Too many people, I would argue. Yes, I guess it's a good problem to have. Is they hold on
The
to that.
hoard.
Yeah.
They live by the routine of their life. They've been so good at living frugal that when they get to retirement, they might have this nest egg and they don't try to use that
Use
money.
it, enjoy it.
And you can, if both of you can answer, why is that? Why don't so many people we work with, why don't they spend their retirement money or leverage the equity in their home to live this elevated life?
Well, that's the question that we have to solve for each and every individual.
Because they need to feel comfortable that nothing is gonna change, nothing is gonna break. They're
Yeah.
not gonna run out
It's
of the
our
money and
job
they're gonna
to
take the
explain
house
that
away.
in multiple
Yes,
fashions,
yes.
using financial planning software, using all the tools at our exposure to help alleviate that fear of running out of money.
I was just gonna say, I mean, fear is everything. Money's an emotional attachment, right?
100%.
We all need it. We all know that we're gonna survive by having enough of it. It's that, well, I don't, social media is at it's part of everyday life now. Everyone has a cell phone and they're looking, and every 5 minutes you can see something bad, right? So they take the fear around us and they say, well, I just don't want to be stuck in that position. Fast forward, something bad happens. None of us do, right? But that's what a plan is about, right? And if you have everything in the right, order, then you should be fine. You should sleep on your pillow at night. That's our job, is to make sure our clients sleep
But
on their
then
pillow.
it goes back
well.
to doing like a yearly checkup.
You do.
You go to your doctor and you do your vital checkup.
Yep.
Do your financial checkup. We do the mortgage checkup.
The key is you go to the people you trust.
Absolutely. And
Right. I go to the
needs
same
be people
doctor.
guide you to get there.
Correct.
And
Go to the
I'd like to wrap it up because we've been going, and there is one more thing that I want to share with you that we do over here. I called a client of mine and I said, I can do this loan for you, but you'll have to pay 11%. And she told me, wow, that's amazing. And I was like, you sure? Yes, sir, Racheli, I'm paying 28% on my credit cards. I'll take 11% any day. What we did, we took and paid off $200,000 worth of credit cards that she was paying 28, 30, 32%, and refinance it. Her payment went down to this 11, but it was 11. It could have been 8.5. But guess what? And this is something that maybe you can talk to your clients about. When you use your credit cards, your utilization debt to income ratio goes higher. No, it's the utilization. Let's say you have a $5,000 card. As you get above 1,500, it starts lowering your credit score. It lowers your credit score. Now you don't pay 15%. You're going to pay 20%. And you get closer to the 5,000, like in their case, they're paying 32% on those credit cards. Now the credit will go back up to the 750, 760. And as long as they are diligent about not going and overexpending, they're taking the same money. They could have taken the same $200,000 from their assets that they have invested. So that stops working. We're here. It keeps on working. They reduced their 28% credit cards, 30% to 11.
Yeah.
And hopefully
And they get it down faster because the payment.
Absolutely. And what we can do once the credit score goes up and the market hopefully will be a little better with rates, we can refinance that debt to a much lower interest rate.
Incredible.
Yeah.
So there is a lot to do. We can't finish it all today. So I really, really thank you for coming today, having a conversation and talking about some things that do affect people day in and day out. So if they want to reach out to you, how do they call you? How do they?
Just go to our website, pathfinancialpartners.com, and you'll easily see a link to get to us.
Excellent.
Thank
Thank
so
you.
much, Kelly. We
I appreciate it, Nick and Jason and Travis. And thank you again. And if you have any other questions, please put it down, ask us, and we put it to
Comment below.
Yes, comment below. Thank you.
Thanks for watching.